Just a reminder, nothing I share here is financial advice. This is all based on my own experience, my strategy, and how I see the market. You're responsible for your own trades, so always do your own research, manage your risk, and never trade money you can't afford to lose. This content is meant to help you learn and think for yourself, not to copy or follow blindly. Let's keep it educational and intentional. Good morning, guys. Let's see what we have on this Friday. Starting with the cycle chart, price is currently bouncing from the 3-month order block after spending over a month ranging there. Almost a full daily cycle was spent inside this range, and now price is breaking out. At the moment, it's trading inside the monthly breaker. Time-wise, if we get a retrace, it should be a higher low based on this context. Of course, if price starts to lose this level, meaning the monthly breaker and the midpoint of the 3-month order block, then it could easily test the lows again or even make a new low. Until that happens, this is the window where we could look for another low if we get a retrace. Why am I saying if we get a retrace? Because in rare cases, price can simply chop higher and set a daily cycle low without really moving down. So we don't always need a drop to form a cycle low. Not for the daily cycle, and not even for the yearly one. More often, we do see a retrace, but it's important to keep in mind that it's not mandatory. Knowing that, and expecting that a retrace could be used to set a cycle low, I'm logically looking for a higher low to be formed. That's the bias here. Similar to what I showed before with the previous month's low, based on the stats, there was about a 95% chance that the low would not be taken out. At the same time, price had already spent a long time ranging, broke out of the trend, momentum started shifting up, and we already had higher targets like 112K defined before the move. All of that creates context and bias. When we have several things telling us there's a high chance to reach certain levels, we naturally look for higher lows to get involved, right? That's a simple explanation of bias in this situation. All of this is happening at higher time frame support. Sentiment is still very bearish, while at the same time bullish signals are popping up. Logically, that should push you to look for higher lows. And if it fails, so be it. We know it would be a low probability event, and more often than not, this approach is on the right side. Once we have our bias and sentiment context, we go down to the lower time frames and look for entries based on that bias, manage risk, and execute. The puzzle pieces come together. As explained before, that's exactly what's happening now. Price is above resistance or trading inside it during a breakout attempt, and at the same time, we're in a daily cycle low time window. The logic here is simple. After a long range and a breakout attempt, the probability of taking out the lows is still low. As long as support holds, I'm looking for a higher low during this cycle window. Only if support starts to break do we shift focus to the next levels. Always step by step. A higher low can form right here at the highs or lower on a retest. If the level is big enough, I'll first look for the higher level to hold, and only if that fails do I look lower. Small time frame levels are different. Those I'd mostly scalp. Bigger levels matter more. In our case, that's the 3-month order block and the monthly breaker. That's the first area where I look for continuation. I'm not talking about much lower levels right now, because I need to focus on what's happening now. If price loses support, we can talk about lower levels again. Until then, this is the area to watch and react to. At the same time, I see some people calling for a drop in the NASDAQ. Looking at NASDAQ, it's also inside a daily and weekly cycle low time window. Even if a drop happens, it would most likely be a drop into a low that then bounces, unless the low is already set. Usually these moves are more violent, but there are cases where the low is formed as a higher low without a hard dump. In either case, I'm looking for a higher low first, until proven otherwise. So both markets are in cycle low timing areas, which means the bias stays up until the data changes. With that said, this is the higher time frame view for now, step by step. I'm not aiming for significant new highs or significant new lows right now. The main bigger picture target remains 112K. I had the bigger target, then looked for support, and once price hit that support and other signals started to line up, I knew the direction I wanted to trade. That's not based on emotions, but on a few data points that help form a bias. Now we simply observe where we are. For example, is the range already big enough time-wise to break out, or does it still need more time? On my non-spot trades, we already hit the second lunar cycle timing, around 32 days, which is roughly 1 month, a good time to look for a trade. Back then, I didn't have the 95% stat for the previous month's low because that was the month I traded, but there were other reasons. Later, price took out the monthly high, and from there I started marking out levels and looking for higher lows step by step, because the probability of the previous month's low being taken out was low. Price could have formed a higher low at the first level or dropped all the way to lower levels. Technically, it still could. But in our case, price formed higher lows in the upper part of the range. That's why trading level by level was so important. Even if some trades failed and price went lower in the end, the losses would be small compared to the potential reward. This isn't about feelings. It's about a few data points to form a bias and then trade that idea step by step. Price can still come down and even take out the monthly low. But more often than not, waiting for that scenario would be the wrong decision because it only happens about 5% of the time, and those probabilities change over time. Right now, we're in a daily cycle low window and a lunar cycle window, where price often moves down to form a cycle low, but sometimes it just ranges and doesn't. That's the first part. We also have the FOMC stats coming up. The next FOMC is on January 27 to 28th, so let's take a look at that next. Okay, what we do here is the following. We look at what happens before the date itself and after. We don't really care about the news itself. We look at what the market does around the news. Very often, people react to the news as it happens, which can be successful or not. But having some historical context in the background helps to make better decisions most of the time. It's not always perfect, but often it adds a few more puzzle pieces. What I mean by that is simple. You can see it here on the chart. There are times where we don't really see a reaction before or after the news. Price just keeps moving higher. We basically have 3 cases. In 2023, we had a breakout of a range, and price just kept going up. In 2024, we had a multi-month long range, and then a breakout again. And yes, of course, we could argue about the reaction before that, because price formed higher lows or showed some reaction earlier. But if we look at the bigger picture, in those cases, price just continued higher after the event. In the last example, it's more or less the same, just a bit later. A similar situation where price was grinding up and moving mainly in one direction. In all other cases, we usually had a reaction before and after the event. So what we do is draw the average time before the news and see where it would land. Well, I already know where it will be. Haha. Anyway, on January 28th, we have the next event. By the way, the last one is still not fully played out yet. We saw a reaction before that, which I traded, and then the reaction after that, where I took the next long after the drop. The targets for that move are higher. The lowest one is around 24%, which is roughly 104K. Now looking at the next date, we can see that the average time for a reaction before the news is around 5 bars. Sometimes it's less, sometimes a bit more, around 8 to 10 bars. But if we stick to the average, we're looking at roughly 5 bars before or around the date itself where a reaction could happen. And we're getting closer to that date now. So combining that with the daily cycle low time window we are in right now, which actually runs from now until around January 26, we can see that this is very close to the FOMC date itself. If we were to get a retrace, the timing would be perfect for that. A retrace into this window to make a higher low, or even a move down, which a lot of bears would like to see. On the other hand, there is another scenario. If price forms the low before the FOMC, then it has the potential to move higher into the FOMC date, and only then, for example, make a higher low and continue higher. It depends, of course, on how high or how low price moves. If price is at major highs around 112K, where a lot of confluences are sitting, then I would most likely look for some weakness there. If not, fine. But if yes, that would be a nice confluence. Until then, as long as price is holding the local range like the monthly and quarterly order blocks, we could see a rise or a choppy move into the FOMC date. Only if these levels fail would I say, okay, price might go deeper for the reaction. And that would then be the type of reaction we often see. A rise into the date, a reversal before or around the average timing, and then a reaction afterwards. Because if price moves down into the event, then I'm looking for it to form a higher low. You can see all of this in the examples on the chart. So a move up into the event in an uptrend is not a bad thing, and reversals from that often lead to a higher low. That's why we focus on our levels. So what we have now, I explained what the bias is and how we proceed further. Based on confluence and cycles, I'm still looking for a higher low, and only if the SR levels fail do we look lower. At least that's my plan. The focus now is to observe how price behaves around these levels. So far, we see an attempt to break out, and unless there are clear signs of weakness, I stick with the plan. Which brings us to the local levels. So let's mark out the averages and see what has changed, level-wise and structure-wise. One last thing on the FOMC stats. Once we have the low set, I start to look for a high to be formed, which means bullish until then. Now, the time window to form a high is usually around 150 days, sometimes a bit more. That would place it roughly around May. I wouldn't like price to take that long to hit my target, but that is basically the time window where a high would be expected. That means as long as the levels are holding and price is not breaking back down into the range and not making a new low, the time for the high has already started. From there, we look for a rise. And if price comes back down again, or even makes a new low and fails to go lower, well, guess what happens then? The time window gets reset and starts from the beginning again. So for now, this is more or less one puzzle piece. Of course, it doesn't carry all the weight on its own. It's always just confluence, and we still need other things to align. So we'll see how far price goes after 112K. Now let's move on. Okay, so we now have our averages and local levels. First of all, I have this 12-hour order block marked out. That's the first level to watch, and we've already seen a few reactions from it. Yesterday, it also had confluence with the average loss level. For now, as long as this level holds, I would look for higher prices. Based on today's average gain, there isn't much room higher unless more volatility kicks in. If volatility increases, then we could look for higher levels and possibly even an SFP into the next resistance. So what does that mean? Is this a good level? Yes, it can be a good level, but it depends on risk management. Right now, the lows are not very clean, so it's reasonable to assume they could still be taken out. Also, today's average loss is lower, which means based on daily volatility, it's still possible that price moves down to the lower level. That means if you trade from this current level, you need to acknowledge that the invalidation cannot simply be losing this local level, because that is not the overall invalidation for price to move higher from this area. The real invalidation would only come if price starts to lose the monthly breaker I showed earlier. Only then do we look for lower levels. Until that happens, this area remains the low of the breakout, and it aligns with today's average, which is important. This means that even if you take a trade from a higher level, the invalidation for the idea sits lower, not at this first local level. Because of that, you need a clear plan for how to handle this situation. You wait for the lower level to be hit, and if it doesn't happen, you miss the trade. Or you take a trade from a local level, but leave room for a wider invalidation. Or you accept small losses if price goes against you, and then trade the next level, or wait for a clear sign of strength. All of these are things you need to think through before entering a trade. On my side, I'm still in my trades, aiming higher, and I'm not really looking to add new positions from here. I'm just observing and doing my analysis to see how price progresses and whether anything changes in the plan. If the level holds, it can be scalped for those who want to do that. It depends on your plan. If it holds, no stress, we wait for the next level. If price comes back down again, then I'll adjust the plan and see what has changed. Until then, there's no need to risk new money if you're already in a trade. If you're not in a trade, these are the levels I would look at. But again, a risk management plan must be ready beforehand so you don't end up going all in from this level if price, for example, collapses down to the 2-day order block. All of this is possible, and you need to be prepared for the scenarios you trade. Stick to them and define your risk management before the trade by adjusting size, leverage, and exposure. Write your plan down for each level, so when the time comes, you simply follow the plan, not emotions. Summary for today. On the higher time frame, price is reacting from the 3-month order block after spending over a month ranging. This is normal behavior at a major higher time frame level. As long as price holds the monthly breaker and the midpoint of the 3-month order block, the bias remains constructive. Only a clean loss of these levels would shift focus to lower supports. We are currently inside the daily cycle low time window, which means a retracement is possible but not required. In rare cases, the daily cycle low can be formed through time while price grinds higher. Because of that, the focus is on how price reacts at support, not on forcing a move lower. At the same time, we are approaching the FOMC window, Jan 27 to 28. Historically, the market often shows a reaction before and/or after the event. What matters is where price is when that time window is reached. A move up into the FOMC followed by a reaction would still fit a higher low scenario. A move down into the event would also favor a higher low, as long as key support holds. On the local time frame, the 12-hour order block remains the first level to watch. It has already produced reactions and currently aligns with today's average loss. As long as this area holds, structure remains intact. If it fails, lower levels come into play step by step. Only a loss of the monthly breaker would change the broader plan, and we would adjust it. Until then, I hope this was helpful. I wish you a nice day, and I'll see you in the next one.